Mavericks. This is Rob Reinhold, and check this out. We are in the second to last trading room of 2024. Next week will be the last one, but this week we've got a holiday shortened week. So let's jump into it. In this session, we're going to be talking about the news of the week. We're going to take a look at the broad markets. As always, we go through all the sectors, score them from +3 to -3. And then I've got 6 setups for you this week. Some bears, some sideways, and some bulls as well.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
All right, before we jump into this week, I wanted to just announce these dates again. I had a few emails of people saying, Rob, what were the dates again? April 26th and 27th. So again, we'll be sending out an email at the first of the year with a sign-up sheet, and we'll also have a link to discounted rooms at the Luxor Hotel and Casino, which is where our event is going to be. Again, you don't have to stay there, but we just have negotiated a discount. If you want to stay there, it definitely is much more convenient. All right, let's get into the news of the week. We had our first sell-offs really since August. This was a deep sell-off. This took us down below the 50-day moving average. We saw a 74% spike in the VIX on Wednesday, and this spike came from the FOMC. We were expecting the FOMC to cut rates by 0.25%. They did exactly that. But what they did is they pulled back from their last meeting where they basically said there's going to be 4 interest rate cuts in 2025. They pulled that back to 2. Now, this is where the market is neurotic. I said this last week. It was widely expected. I have heard many people on CNBC talk about how the Fed's going to say they're going to do less rate cuts. Everyone knew this was coming, but the market sometimes is neurotic, and it was like surprise. And I think just we got a cascade of selling, people bailing, and you can see a big plunge on Wednesday. All right, so big plunge on Wednesday. We gap up on Thursday, and then we lose all of our gain on Thursday. We were trading down about 1% overnight Thursday night, and then the PCE price index came in and really rescued the market on Friday. That being said, we closed well off of our high on Friday. We're going to take a look at these charts, and you're going to see that we are at a point where it is a coin toss, I think, where the market goes from here. Let's take a look at some of the economic news, and I'm just going to keep using the word mixed. So again, we had things like manufacturing and retail sales. Take a look. One number beats, one number misses. Retail sales headline misses, the core number misses. So we are getting really mixed signals here. This GDP was not mixed, but this is the final reading for third quarter. So this is the number that goes in the books. The third quarter GDP was 3.1%. That is a very, very strong economy. Take a look at this Philly Fed manufacturing index. It was nasty. It was ugly, but these things are super volatile. And then, of course, we got the core PCE price index that was 0.1%. That was a miss. Now, again, that's good news, meaning that inflation is lower than expectations, at least when it comes to the core PCE price index. At 0.1, again, the market was relieved. They said, oh my gosh, maybe we will get, at least 2, if not 3 rate cuts next year. This is one reading. If we keep getting more of these 0.1 readings, 0.1 times 12 is 1.2%. That's actually lower than the Fed wants. So if we start getting a few of these at 0.1, we're going to see those interest rate bets come back, but it also is going to be a little warning sign that maybe the economy isn't doing so well. Overall, the numbers this week said the economy is fine. Not great, not terrible, but fine. 3.1% last quarter, which was a very good number. But look, going forward, everything is showing that the economy is doing just fine. So the market had that big sell-off this week. We'll take a look here at the charts, but let's look at the final numbers here. Dow, S&P, and NASDAQ all down about 2%. Russell getting crushed 4%. That's a big move down. Oil, gold, they were down for the week. Basically, everything was down for the week. Let's go and look at these charts and see what happened on a technical basis. First thing I want to point out is that we did break below the 50-day moving average. In an uptrend, it's very, very typical that you get these uptrends. And when you get these pullbacks, a lot of times they pierce the 50-day moving average. And I want to go all the way back here to September, where we pierced back in September 1st. And you can see here, we spent a total of 3 days below the 50-day moving average. And then we recovered and had a really nice run here to where, we had a new uptrend started. We pull back to the 50 here, a new uptrend started. So look, I know these pullbacks to the 50s are painful, but in the last 2 times, it was really good if you stayed bullish. Here's the thing. At one point, one of these pierces is going to turn into something worse. This one might be the one, but if you trusted in your charts and stayed bullish, then you were very happy that you didn't bail and go heavily short. We're here again. I have no idea what's going to happen next week. And anyone who says they know, they're lying. We did not close on our high. We lost gains at the end of the day, and we literally closed right on that 50-day moving average. Next week, one of 2 things is going to happen. Well, actually, I shouldn't say that because next week is a holiday shortened week. We could have a sideways week, and then the real action comes on January. But here is my life experience for the last 27, 28, 29 years since I've been trading. When the economy is doing well, when the economy is doing okay, stocks tend to go up over time. They have pullbacks. Every now and then they'll have a 10% correction. But the bull market typically continues. There is nothing out there in the news that is going to tell us that the economy is in trouble. For this reason, I do think this is more likely than not to be a pierce, where we look back on it just like we did back in September, when at some point you could have panicked, but you could see it actually recovered. Look, it may not happen, but if you trusted in that over the last 2 times, you were really rewarded well, and we got massive rallies off of these sell-offs. I'm not saying it's a guarantee we're going to get a sell-off. I'm not guaranteeing that it's going to be just the same as last times, but this is charting. You trust your charts, you trust the trends, and if you really want to become bearish, this is what has to happen. You need to pierce, bounce, fail, and break below this past low. So really, at 58.30, if you want to get bearish, and you say, Rob, I think you're wrong, I want to get bearish. Well, guess what? At 58.30, I will join you. I will absolutely join you. If we bounce up, fail, and crash, then that means it was different than this time. It was different than this time. As you can see, there was no bounce back, fail, and break below that level. That's what has to happen technically before you can get overly short. So at this point, we are just in a deep pullback, and odds are, and again, this is odds like 60-40 odds, that we are going to resume the bull market at some time in the near future. We take a look at the NASDAQ. This is what the NASDAQ is saying. Now look, I'm going to make this really cloudy now because I just came out, said this is what I think is going to happen. Here's the NASDAQ. We didn't even break below the 50-day moving average on the NASDAQ. But remember last week when I talked about the RSP? The RSP is the equally weighted ETF for the S&P. Yeah, this looks terrible. And this is atrocious. And you've got a major break in major support. And this thing is now a mile away from its 50-day moving average. Okay. I talked about this last week. I'm going to talk about it again. You can't, when you don't get the data you want, or if the data you have been using for a year all of a sudden you say, I want to change to new data. That's the wrong decision. So I brought up this RSP and I said, hey, look, we have to be at least understanding of what's really happening out there in the market. But you can't all of a sudden say, I'm going to use the RSP chart as the chart I now look at, and I'm going to throw away the S&P chart that I've been using for 2 years. That's a mistake. If you want to make a change, then you make a change of things like, on March 1st, I'm going to make the change. As you can see, that gets you out of this reaction. Okay, I want to make a change because it's not giving me what I want right now. You put it off, you make a date, that's when you make the change, and that's fine. But to make a change right now is wrong. Even if it is the right decision, it is still wrong. So guess what? We are going to stick with the SPX, the S&P 500 chart. If we want to make a change, we'll announce it and make a change later. But right now, this market is a zero. All right, let's talk about what's going to be happening this week. This week is a holiday shortened week. We've been talking about the erosion under the surface. Last week, we had, of our 10 sectors, we had 7 that were below zero and only 3 that were above. We've been talking about the weakness in the market. So we cannot be blind to the fact that this market is seriously deteriorating. We just had a big, massive pullback, and even the things that were holding up really well, the large cap tech, they got hit this week. So here we are, we're moving into the last week of the year. Now this is what's called the Santa Claus Rally Week. Now the Santa Claus Rally is the last 5 days of the year and the first 2 days in January. Some people include 3, but I was reading and it's the first 2. It doesn't really matter. What this is, they've looked at all the past years and they've said there is a real bullish bias during this period of time. Some years it did not appear. Some years it was a bad year. But over all the years, this has been a seasonally good time for equities. Will it happen this year? I don't know, because we usually don't get a big spike of volatility the week before Christmas with a big pullback. That's not something that usually happens. So I don't know, but just understand that this is typically a very bullish week. The markets are going to be closed with the holiday falling in the middle of the week. The markets are going to be closing early on Tuesday. So they will close at 1 p.m. Eastern time on Tuesday, and markets will be completely closed on Wednesday. So basically you have a day and a half on Monday, Tuesday, 2 days on Thursday, Friday. And then we have literally the exact same setup next week for the New Year's holiday. Since it's a holiday, there's really going to be no news events you need to even be concerned about. So going into this week, the technical score is a 0. The technical score is a 0. I'm going to be treating this as a deep pullback, but cautious that this might be the start of a bear market. So for me, that's how I'm looking at it. That I'm going to be a chicken bull, where I'm going to be leaning a little bullish, but not all that bullish. And if we do have that breakdown, then I will join the bears out there that have been calling for a bear market for years. I'll go ahead and join them and be very happy because I love trading in bear markets. Let's go ahead and look at some sectors.
Have you been trading in the markets for at least 2 years? Are you starting to see some decent progress? Is that progress so small because of your limited account size? Maverick Trading is a prop firm that provides capital to profitable traders. You trade a minimum $25,000 account and keep 70 to 80% of the profits. After 2 consecutive profitable months, you move to a $50,000 account. As you keep progressing, you will be able to trade 6- and 7-figure accounts. To learn more about trading for Maverick Trading, either click on the Apply card in the top left, click Apply at the end screen, or click the link in the description to watch our recruiting video that explains more about Maverick and prop trading. If you like what you see, apply for a position and meet with our recruiters. Are you our next trader?
As you can see, everything went down. And pretty much everything went down 2%. The only thing I can point out in this as far as what's the strongest, take a look at tech. Tech held in really well. Apple was actually up on the week. So tech was the shining star this week, and it's not going to surprise you that the bullish trade I have is in the tech sector this week. But take a look what was horrible. Materials and energy got absolutely hammered. Materials was at a -3 last week. Energy was at a -2 last week. Real estate was a -2 last week. So our weakest sectors have been real estate, healthcare, and materials and energy. And that is where the weakness was. Our strongest sectors were technology, comm services, and consumer. And you can see comm services and consumer actually sold off a little bit more than the market. So they're going to get a little bit more of a downgrade than everything else. Let's go through all of the sector charts one by one and update our scores. Utility was a -2. And we're going to stay at a -2 until we get some more steepness in those moving averages. It's probably like a -2.5, but look, once you see the other -3s, you'll see why this is a -2. Communication services had a big pullback last week. Big pullback. And this candle on Friday, not convincing of a real big bounce. That being said, we are at a +1. We are at a +1 on this, so down from a +3 to a +1. Here is real estate. Remember what I just said about utilities being a -2. This is a -3. This is really just fell out of bed. It had a huge down week. It would not surprise me at all if it had a bounce this week. Would not surprise me. But this is still a very bearish sector. So we're going to stay bearish in this sector. Healthcare was our most bearish sector. We're going to stay bearish in this one. But I do want to show you, of all the sectors we looked at, none of them traded higher than they did on Thursday. And healthcare did. So this is a good sign of, okay, we're likely to get a decent size bounce here. So I would just love to use this bounce to sell into and enter another short position. That's all this is saying to me. So I like the -3, but this one's showing more bounce than anything else out there. We come in here to industrial. Industrial also had a decent size bounce. Again, I want to compare this last candle on Friday to some of the other sectors. But look, it wasn't a -1 and it definitely deteriorated to a -2. So -2 on industrials. Financials was a -2. Sorry, it was a 0 and it deteriorated to a -1. But again, look at these candles. These candles are much better than the candles we saw on some of the other sectors on Friday. It doesn't mean they're not bearish, but they're just not as bearish as others. Coming over here to consumer. All right, consumer was a +3. Was a +3. It's going to be downgraded to a +2. But look, I don't love this candle on Friday. So we've just been looking at the Friday candles. And you can see that this one almost closed as low as it did on Thursday, even though the market had a decent bounce. This is telling me this has got a little bit more to go. Look, I'm not panicking on my consumer position I have at the moment because I don't panic. But I'm also not looking to get super long here on consumer this week. I want to see if this thing can bounce a little bit before I jump into it with another trade. All right, here is tech. Look at this candle. Now this candle is a nice bullish engulfing candle. So we have a much better candle on Friday, and we really didn't stay any meaningful time down below that 50-day moving average. So instead of a +3, it's moving down to a +2. You could maybe call it a 1.5, but I'm going to give this a +2. And then we come over here to just really abysmal sectors. These are the worst sectors out here. Materials looks horrendous. It was a -3 already. It just continued to be a -3. After this kind of a sell-off, do I expect a bounce? Yeah, I expect a bounce. But I'm using that bounce to sell into when we get a nice little bear rally. And then the energy sector, same thing. Just abysmal. Those Friday candles are looking horrible. Yeah, it bounced a little bit, but boy, it is not showing like the tech sector. We saw that big bounce in the tech sector, that bullish engulfing candle. We're just not seeing that here in energy. So energy is also now a -3. If we take a look at what happened here, we see that two more sectors joined our -3. So energy, real estate, materials, and healthcare is where all the weakness has been. I do expect some bounces in healthcare and probably in real estate, but the energy and material sectors, they still look like they've got some downside to me. Industrials and financials took a downgrade just by 1. So yeah, they're weak, but they're not like the worst things out there. And then our 3 strong sectors is held up from everything. They all took a little bit of a hit, and you can see that tech and consumer remain the top. But for me, technology is a step above consumer because of Friday's candle. All right, with that being said, we've scored our sectors. Now let's go ahead and take a look at where our trades were. We actually had 6 trades roll off this week. And our basket strategy did its job because we were leaning to the bull side, but we had these bears that were just hanging out there. And what happened was the market did a big pullback. And so our bullish trade in industrials, Fastenal, max loss. Sweet greens in consumer, max loss. CRDO in tech, max loss. But our Duke Energy trade was a moderate gain. Our trade in real estate was a almost max gain, and our trade in healthcare was a max gain. So we had 3 winners and 3 losers, and we were leaning the wrong way when this big sell-off came. That's the point of this basket, is that it helps you weather these unexpected storms, and then now we can rescore everything and we can build back in to the positions that we want. Looking at the markets, we determined we were at a 0 in the markets. So that's going to give us this allocation right here. So these are our open slots. And if we take a look at where we are, the black ones, our trades were already in. So we're already in these sectors. So we're going to be adding in 1 utility stock on a neutral, 2 bearish ones here in real estate and healthcare, a neutral one here in industrials, a slight bull here in technology, and my favorite short sector is energy. Energy looks to me like it's definitely going to it's most likely going to head lower. As you can see, when we total all of these up, take a look at the allocation here. There's nothing out there on +3 or -3. Everything's near the center, which is kind of where you are or where you want to be in a 0. But you can see this is leaning a little bullish. It's leaning a little bullish. And if we do get a bounce in the market and our strong sectors bounce very nicely, this comms services is going to be very nice. Our consumer and tech trade are going to be really nice. And if our sectors that are weak continue to stay weak, these trades should at least be either neutral or make us some money. So again, this is the whole strategy, is to try to match and mirror the market as much as possible. So we got 6 trade setups. Let's jump into them. Let's start off with the utility sector first. With utilities, I had to look and see something that had weekly options because we just ended up with monthly options. I didn't want to be all the way out till January 17th. So I looked at some of the more higher volume ones, and it came across this PCG. It's a Pacific Gas. It's a utility company in California. You can see we've reached the bottom of its range, and every time it's gotten down to this 1930 area, it's had a nice little bounce. That being said, it is weaker than stronger here. On all of our sideways trades, remember, we need to pick what the midpoint is. This one has dollar strikes, so I'm looking at this 20. This is slightly bullish, very, very slightly bullish, but the 19, 20, 21 butterfly. So this is our butterfly, and this right here is going to be our profit area. So that is a really nice profit area, and we're giving that 2 weeks out to January 3rd. As you can see here, this is not a crazy trade. It's basically saying, hey, let's try to collect some premium here if the utility sector goes sideways. Next up is our real estate trade. Looking for real estate to become bearish in, but again, mildly bearish. We're not really looking to go crazy on +2s or +3s. We're looking to be in the center with mild bulls and mild bears. This is Annaly Capital, NLY. As you can see, we had a big fall. We had a little bit of a bounce. If someone said, Rob, I want to wait for this to bounce until it gets up into this 1930 area, 1920 area, I would not disagree with you. And it probably does happen. But I can't tell you how many times I've said, I'm going to wait for it to bounce, get up into this 1940, and then I'm going to put my trade on. And guess what? It never happens. It never bounces. It low bases. And then it actually just falls, and I never get into it. I got everything right, but I was just really needed that extra little couple pennies. So this is where I just get the right delta that I want, get the right Greeks that I want, and then I make the trade regardless really of waiting for that little bounce. I'm going to be looking to put on the January 10th. So this is 3 weeks out, and take a look at this. A 1950-19 bear put spread. I don't do these 50-cent strikes very often, but this stock is not very volatile. So it doesn't move much, so it's pretty much the only trade we can make on it. This is the window. If it goes and breaks out above this window, you got a max loss. If it trades somewhere in the middle of the window, you might have a gain or loss depending on where it closes. If it closes below 19, which I really like this thing, the odds of it closing below 19 within the next 3 weeks, then that will be a max gain here in the real estate sector. Next up, we also want to get slightly bearish in healthcare. All right, Eli Lilly. I want to talk a little bit about the news that came out. So Eli Lilly and Novo Nordisk and Amgen, they are the three big drug makers with these GLP-1 drugs. I'm talking about Ozempic, Wegovy, all those things. And they've been just blockbuster drugs, just amazing drugs. And all three of these stocks have gone up substantially. This morning, Novo, they announced that their new GLP-1 drug, failed a phase 3 clinical trial, which means that these companies, Eli Lilly and Amgen, won't have as much competition in the next 1 to 2 years because Novo was their main competitor. So the stocks gapped up. And you can see the stocks gapped all the way up to $810 a share and proceeded to sell off and lose $50 today. I love this kind of price action. This tells me that there are not buyers, even when there's good news. When great news comes out on something and it sells off, it's screaming at you that this stock wants to go lower overall. So I love this kind of candle. We're going to call this a bear rally, even though it's a weird candle here. But I'm just looking to get short here on Eli Lilly. It's a -1 trade, so I'm not looking to get crazy short. It's going to be a very, very mild trade. So we're looking at that should be 770 to 765. So again, 770 to 765. And you can see we're talking about the wimpiest trade, 770 to 765. We're playing it in that small little window. If it's below that by January 3rd, we get a max gain. If it's above it, then it's a max loss. If you want to get a little bit more aggressive, the 770, 760. Still not a very aggressive trade. It just needs to, go down by 7 points, which this thing's moves 7 points sometimes in an hour. Very, very possible here on Eli Lilly. I love the fact when there's good news and it doesn't go up. It's just screaming at you that it wants to go lower. Next up, moving into industrials, we had a zero trade on in industrials. So here is 3M. 3M, as you can see, has been sideways. And I really like the fact that it didn't crater with the rest of the market this week, had an up candle on Thursday, and this Friday candle is really nice. Really, really nice. Remember, whenever you do a butterfly, you have to say, okay, where is the midpoint? Where do I think it's going to be in 2 weeks? We're not saying I think it's going to go sideways. It's where's this going to be on January 3rd? I'm looking at this and saying, I actually think it's going to be a little higher. I still think it's going to be sideways, but I think it's going to be probably up here at 131. So I'm using 131 as my midpoint. So I'm looking at the 127, 131, 135. As you can see, this is a slightly bullish butterfly. So even though we had this as a 0, this is probably more like a 0.5. So again, we're tilting a little bit more bullish here using this butterfly in the rest of our portfolio. Just 2 weeks out, the January 3rd. Right, tech was the sector I liked the best. It held up well. It's got a nice +2. And look at this chart. Apple, I was so surprised when this came up on my screener because I really don't notice individual trades. I don't watch like Apple and Tesla and Nvidia. I just don't do that. I don't care. It surprised me. And these candles are beautiful on a week that the market sold off. Yes, we took a hit on Wednesday, but on Thursday, it had a green candle. On Friday, it closed at the high of the day, breaking out all-time highs. Look, this is a beautiful candle. If this market bounces this next week, this stock should be at the forefront. I'm doing a +1 trade. That was what my allocation was for. So I'm looking to do a 1-week trade at December 27th, 250, 255 bull call spread. I'm going to pay $3. That means I got $2 of upside. All it has to do is not go down for next week. It's a holiday shortened week with a bullish bias on it. It's a strong stock and a strong sector. Again, I have no idea if it's going to actually work, but we're stacking all of the odds in our favor for it. If you do want to be a little bit more bullish, go out to January 3rd and look to do a 255, 260. Again, just looking to up to 260. That's possible in a couple of weeks. Let's finish this off with the worst sector, in my opinion, energy. This was a tough sector to look at because energy's been weak for a while. And there's a lot of stocks that had just been absolutely decimated, down 30, 40, 50%. I'm usually okay with that because the best shorts are usually the things that have been the weakest because they're weak for a reason. Usually their businesses are in trouble or some other thing. But when I was looking through these, I thought, you know what? I want to actually get something that is in the start of breaking down because I'm at a -2. That was my allocation for this. I want to be -2, so I need something that's actually going to move down. And I think at any time there could be a fairly significant bounce. So I was looking around. I came across this Range Resources. We came up, failed to make a new high, made a new low. Look, this could be like an ABC correction if you're Elliott Wave. But the sector here is very weak. So I'm looking at this thinking, okay, if we do break this level, I think the next area of support is down here at 31. If it breaks that, we're down here at 29, and I'm willing to give it some time to break down. I'm going out to the January 17th. This one only has monthlies, so that's your only choice. But I see no reason to think that, hey, over the next month, can this thing work its way down? I think the sector is going to stay weak. I think the energy sector is going to continue to fall. So I'm going to pick one that's been a little bit stronger, but has started to break down recently on this. If you're looking for maybe something else, if you're looking for a -1, I'd definitely go with something that's had some recent, weakness over the last month or two. This just had some weakness over the last week or two. All right, Range Resources on the short side. Let's go ahead and wrap this up. We've had a big sell-off. We had our volatility spike. We pierced below the 50-day moving average, and we had a little bounce up, and it parked itself right there. One of two things are going to happen. Either this was like the other two times over the past 4 or 5 months that we've seen a pullback to the 50, and both of those times have been fantastic times to start allocating to the long side and start building up your watch list and at least building up your trades to the bullish side. Yes, at one point it will fail, and it won't be that. It'll be the bearish one where it breaks down. We don't know yet. We don't know. I'm putting odds of 60-40 on this, that it goes higher, not lower from here. But of course, that's not very confident. So that's why I'm really sticking to in the middle. I'm not looking to get overly bullish here or bearish. I'm willing to just wait and see. I'm willing to wait and see. I'll take some singles. I'll take maybe a double or two, and I'll just wait this out until we see where it actually goes. It would not surprise me if we got a bounce this week and then got a little bit of selling next week, or maybe starting in January, some selling. That would not surprise me whatsoever. This is a seasonally strong time of the year. There's going to be a lot of people not there trading, a lot of people on vacation. They tend to be bullish markets when we see that. So keep that in mind. But ultimately, if we get a bounce and that bounce fails and we break down below that last low, then we will go to a much more bearish stance in 2025. Everyone have a wonderful, wonderful Christmas. I will be here again next week on Friday, and we'll be getting you ready going into the new year. Merry Christmas, everyone.